The difficulty is, as we've discussed on previous programs, is the timing of stimulus versus the timing of the economic downturn. The economic downturn is immediate. To use a sports analogy, effectively the global economy has hockey stopped or come to a very, very abrupt halt. The challenge to that from a Fed as well as government fiscal policy perspective is both of those take time to trickle through into the broader economy. And so we're seeing an interesting dynamic now where the efforts on the behalf of central banks and regulators have clearly propped up liquidity, have clearly propped up the plumbing of the global financial system, and has kept markets operative. They have not fallen through and actually stimulated the actual underlying economy yet. And so we face an interesting situation where by the time the global economy starts to revive, and again, we're seeing signs of that very clearly in the second quarter GDP numbers in China, all of this fiscal and monetary stimulus might actually start to hit. You could ironically end up in an overstimulated second half position, which is a risk that we're watching very closely, particularly from an inflation expectation perspective.
Yeah, and on that expectation, James, good morning. Tanveer also joining in. You're talking about global inflation looking to drop to 1.3% in late 2021. I thought all this money supply, all this injection of liquidity would raise the risk of inflation at some point.
The problem ultimately is that debt is long-term deflationary. You're taking growth from the future and bringing it into today. So the higher debt levels get at both the government as well as the corporate space, you are effectively shorting or borrowing forward future levels of growth. To the degree that we're doing that to effectively smooth over this short, very, very historically negative impact on global growth, that is by definition negative to future growth profiles. J.P.Morgan estimates have the global economy permanently losing about 75% of 1 year worth of earnings, or about 4% of global GDP, and that's a permanent reduction relative to prior trend rate.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.